Hi, everyone. It's John Pocoroba. It is Friday, November 11th, 2022, and it's time for a general market update. Again, the presentation is made by Rain King LLC for educational purposes, and I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So the quick agenda is to go over the big picture, some market internals. We'll also talk about the follow-through day we had yesterday, and I want to talk about the benefits of weekly charts. This is the monthly NASDAQ as of September 30th. Again, the whole premise being the big super cycle and this zone between 10,000 and 11,000 acting as support, which it currently still is. This is a weekly chart of the same NASDAQ composite. I've just drawn a line at the 10,000 level. That psychological 10,000 number is still holding as the lows for the NASDAQ, which coincides with approximately the pre-COVID peak. This is the ARK Innovation Fund. This is actually a monthly chart, and I just thought I'd toss this in there. It's just amazing what the market can do. This bear market has really taken the ARK from its all-time highs all the way down, and it's actually touched or slightly broken its COVID lows. I mean, 2 years ago, you would have never ever anticipated this could ever happen, but the market has a way of bringing down egos and confidence in a way that can be devastating. And something that looked really cheap a year ago actually has gotten much more cheaper. So I want to look at some market internals. Before we jump into some technicals, just wanted to show this chart, which I thought was interesting. This is the Fed rate hike pace. It takes a number of different years as examples. In the blue, this is the current cycle that started in 2022. And you can see how this is one of the fastest, steepest rate hike cycles the Fed has ever undertook. The next one of steepness and pace is actually 1994. And you can see some of the other years on the chart. 1994, just to give you some perspective, here's a weekly chart of the S&P 500. 1994 was essentially a choppy, sideways corrective year for the market. You can see that it really went nowhere for about a year. But the important thing was the other side. Once the rate hikes had been digested, it actually set the market up in 1995 for a significant advance. You can see right here on the chart, starting in 1995, the market really went on a tear. And so it's just some optimism here that eventually when the pace of the hikes and the terminal rate of the Fed is met, there is another side. There will be another bull market. So here's some charts. This is the small cap index divided by the S&P on the left. And what I'm just trying to show here is that this is a 2-year chart. You can see that the small caps, the IWM, have been outperforming the S&P since May at least. And you can see when the new lows are made in the S&P, I've drawn these vertical lines to show you the relative strength of this comparison. On the right is the mid-cap index. Similar story. The mid-caps have been outperforming as well. The mid-caps have actually even stronger. They've taken back their 200-day moving average here in the teal color. The small caps are still below it. So the mid-caps are even acting stronger. This is a good sign when mid-caps and small caps are starting to outperform, and they have been for over 6 months. This is new highs minus new lows. On the left side, we have the New York Stock Exchange, which just got into net new highs a couple of days ago, which is a positive development. We had that over the summer a little bit. We have to see if we can get some momentum here. On the right side is the NASDAQ new highs, new lows. Using the Wall Street Journal's numbers, the NASDAQ has not gotten to net new highs yet, but it's getting very, very, very close. So these are positive developments. It may take a while here because there was such a devastation to the market this past year. This next chart is the New York Stock Exchange advanced decline line. This is a a chart just showing advances over declines. We want to see this rising to confirm the price action in the S&P. And, it's acting so far. This is acting good. We're in an uptrend. We're getting new short-term highs. And we've actually gotten above the 50-day moving average. So take it day by day, but we want to continue to see this. We don't want to see this roll over on the rally. That would be a bad sign. So we'll keep monitoring this week to week. This chart is something that I tweeted out. This is just showing the bear market and the number of follow-through days that we've had since the bull market highs back in last November. So we've had 7 follow-through days. The last follow-through day was here in mid-October, and we undercut the low of that follow-through day. And then just yesterday, we had a very powerful day on the NASDAQ, up 7.35%. It was the best day percentage gainer since April 6th of 2020, which launched the COVID bull market. 2 ways to look at this follow-through day. Technically speaking, it is that follow-through day number 7, though it broke the low of the follow-through day, it did not break the low of the initial rally attempt. So this could be considered a subsequent follow-through day to the number 7 follow-through day. But regardless of how you interpret it, it was probably the most powerful day we've seen in a very long time. We'll see if it has some lasting effect with this rally. So I wanted to move into some weekly charts and how they can relate to building your watch lists. So weekly charts are important, particularly when you're in a market with a lot of volatility. We've had tremendous volatility in 2022 in the bear market. And if you're only looking at daily charts, it can be very choppy, very noisy, and it's hard to really get a sense of what's happening and where to enter a position or where to exit. So weekly charts are really important to kind of reduce the noise associated with that big daily volatility. So particularly at a time like now, I think it's important to go back to looking at weekly charts, and we want to look for signs of accumulation. I want to go over what some of those signs of accumulation would be. It's almost a checklist you could use. So at this point in time, weekly charts, we're looking for bases, and we want bases that are not too deep. I would say 20 to 30% deep is the maximum. And we prefer the bases to be close to new highs. And the reason is that if they're at new highs or very close to new highs, they're showing relative strength, and there's less overhead supply. There's less sellers to get through that could hold down the stock. We want to see in those bases, a good sign is when we see 5 weeks or more in a row that are up, blue weeks, if you're using MarketSmith. It's always a positive to see tight closes within the base. And tight close would be defined as being closing prices that are within 1 to 1.5% of each other week to week. So those tight closes mean some institution is starting to control the price ranges of the stock. Another positive sign is looking for peak closes on those weekly bars. Sometimes the daily noise is so wild, but we want to know where it closes the week. And if it closes the week near the highs, that's a positive sign that some institution is buying up the stock towards the end of the week. Big blue volume spikes, we want to see positive up days, up weeks with big blue volume, hopefully much higher above average. And these really show up pretty well on your weekly charts. Now, when we do have down weeks, and we will within bases, we want those red down weeks to have come down lower volume relative to the up weeks. Just shows that there's not as much selling pressure on the stock. And again, this can reduce, by looking at weekly charts, this can reduce some of the volatility on noise on the daily charts. And we also can look at the relative strength line. We want to see it near or at new highs in the base. We also, another way to look at it is just look at the slope of the relative strength line. We want to see a steep slope of relative strength increasing, preferably pointing to kind of 1 o'clock on a clock while it's still in the base. That's a very strong sign. And fundamentals. You can look at some fundamentals. I'd encourage you to look at the 2023 earnings estimates. Try to find estimates that are at least 25% or more. And you can look at some of the mutual funds. Do you want to see mutual funds increasing over the last 2 quarters? 3 quarters is positive. And it should have an AD rating, which is accumulation distribution rating in MarketSmith, of an A or B. These are really good things to see on weekly charts. So let's look at a few. I've just shown three here today to show what I think are some of the stronger names. The first is Impinj. You can see this weekly chart here. The relative strength line is obvious. It's very strong. It's an RS rating of 99. You can see that this stock has come way off the bottom, come up the right side, and it's taken time to digest its gains. You can see the little base that it's formed here. And then it had it's probably one of its biggest volume days ever on a weekly basis to break out of that. And it's been acting really well since. Halozyme, Halo, has also formed a cup base, again, right near new highs is what we're looking for. The blue dot is showing you the relative strength is at new highs just before it broke out, and it had a very strong week this week. So you can see big blue spikes, and you can notice that when it was in the base, particularly on the right side of the base, the red weeks on the right side of the base are below average volume. Then I put in Insulet Pod. This is a kind of wide and loose structure, but the last structure here, this kind of cup formation, starting to get a little bit better. But when you look across the entire profile of the base building, you can see big blue spikes. So that's a positive sign. It had a very strong earnings reaction, and that broke out of this consolidation this past week, a week ago. So the big blue spikes are encouraging, and all the red weeks are fairly contained below. Other than this week, we actually had some pause in the stock. So there's a lot of names. It's tougher to find names right now. There's not a lot of stocks actually in this situation with bases are near new highs. I've put together just some tickers for you to look at over the weekend. Take a look at some of these. Some of these have some really strong characteristics, as I mentioned, about looking at the weekly charts. Some of these names, though, are still way low in the base because they've come off their highs. But the important thing is many of them have a prior uptrend in place before they're building these low-level bases. So here's some names to dig in over the weekend that might have some potential. Now I wanted to just quickly look at the index strength. I labeled this kind of good, better, and best. If we look at the NASDAQ, we had the follow-through day yesterday, very powerful, and we had some follow-through. We've cleared the 50-day moving average. That's really good. We held the October lows, which was that key reversal week I mentioned 2 weeks ago. And it was key because the higher than expected CPI news could have really tanked the market, but the market was resilient and we reversed higher. So that was a very important day. And then this week, on the lower than expected CPI number that came out, the market rallied with a very powerful follow-through day. So that's an important gauge of some of the sentiment on the index. That's positive. The S&P is better in the sense that it's already above the 50-day moving average, and it has been before the NASDAQ. And it still remains, though, below the 200-day moving average. So it's got some work to do. There's going to be some resistance potentially, ran into resistance back in August. But the S&P has been acting a little stronger because of some of the oils and energy names. The Dow is actually the best. The Dow has been extremely strong, and it's actually rallied above its 200-day moving average, and it's above the 50-day moving average. And the 50-day moving average of the Dow is actually curling up into an uptrend. So that's actually the strongest. So it's kind of a good, better, and best scenario. We'll have to see as we move forward. If the rally is really going to have legs, we're going to need breadth. The breadth, we hope, is going to come from some of the growth names, which would mean the NASDAQ would have some catch-up to do. So the market is, trying to find a bottom. I would say that it's still a kind of a take it slow market. Pilot positions with the follow-through day are probably in order, I think, but you have to be very selective because when you really look to see, there are not that many proper bases showing those signs of accumulation. There are some, but not a plethora of those. So I think it's still, you got to be a good stock picker. And also, uh, in general, the damage has been very, very harsh on the market. So there's still lots and lots of overhead supply. So this market could, grind and chop its way along the long sideways for a while and grind maybe more with an upward bias. But it might take time. It's going to take time. It's probably not likely to be a straight up from the bottom recovery because there's still a Fed and rate hiking mode. So take it slow, be selective, do your homework, and I encourage you to look at weekly charts. So that's all the time I have for now. Just wanted to let people know that I have a new email. If you want to reach out to me with a question or a comment, rainking@gmail.com. You have my Twitter. You can see these on YouTube. But I also wanted to put out a special thank you. That is really a thank you to all of our military and veterans and their families who protect our country and they protect our freedoms. And on today, Veterans Day, I want to make sure that we put a shout out to them and thank them so much. That's all the time for now. Thanks, everybody. We'll see you on the next General Market Update.